Hi, it's Sam Rules here, Portfolio Specialist from T. Rowe Price. This is another update on global markets for the week ending 15th of May. We've actually seen a lot less volatility in markets over recent weeks, but also my wife and I are welcoming our second baby in the coming days. So we're going to pause these updates and come back to you with a summarised update at a later date. Global markets were weaker last week by about 2.5%. We saw the US market underperform and a little bit of catch up from other markets. Australia was an example of this, where in the prior 5 weeks, Australia had actually lagged the US market by about 11.5%. In terms of what the market focused on broadly though, it was really a bit of Groundhog Day. So the market continues to focus on the big three key themes, being stimulus, a reopening, and then also the tensions between US and China. On stimulus, last week it was all about the US. US money markets for the first time in history had started to price in the possibility of negative interest rates. So we then had the speech from the Federal Reserve Chair, Jerome Powell, who effectively said this is not something they're considering at all at the moment. But he also gave a more somber outlook for the US economy, and the markets didn't like this. In terms of reopening or easing of lockdowns, we saw this continue around the world. It was absolutely fantastic to see this in Australia over the weekend. But what we also saw was that the path won't be as smooth for everyone. So in LA and New York, they actually pushed out the timeline for easing their lockdowns. Then when we had the US and China tensions, these continued to escalate during the week. We saw US impose stricter access to the supply chain for Huawei, but then also more finger pointing over the origins of coronavirus and China's role in this. Out of China more specifically though, we had a little bit of data come out on Friday about their economy. It looks like throughout April that industrial production and PMIs continue to recover. So it looks like the economy is about 80 to 90% back to normal, but there's a discrepancy here between the supply side of the economy and demand. So it's really something where we're not seeing the consumer or retail demand come back quickly or at the same pace. And that's something that we'll continue to monitor over the next few months. Focusing on our global equities portfolio, we believe we've really seen 4 key phases in 2020. The first 3 phases were really phase 1, which was pre-coronavirus, followed by phases 2, which is where we saw the steep sell-off, followed by a steep recovery. That though brought us to phase 4 in about mid-April, which is where we believe we are today. And during this period of about 4 weeks, markets have traded broadly flat point to point, despite a little bit of choppiness in between. So we've actually been quite active and nimble in the portfolio this year, and we've been able to outperform in each one of these phases. But I wanted to give you, on an outlook basis, some of our positioning at the moment. So in terms of sectors, our largest overweight is in financials, and you may recall some weeks ago we actually brought this up from an underweight position, but we prefer the capital markets facing businesses here as opposed to more of the traditional banks, which are challenged in an era of lower interest rates. Our second largest overweight is in consumer discretionary, where we're favouring more the online e-commerce players. These are businesses that are accelerating their market share gain, but also seeing very strong, healthy demand throughout this crisis. Where we've reduced some of our positioning is actually in healthcare. So we've taken this from a sector overweight to around neutral. And that's really driven by profit taking in some of the larger big cap pharmaceutical names. But we do still like companies in the life sciences and biotech space. Where we remain underweight is in consumer staples. We just believe right now is not the time to be that defensive. And for the risk reward that we can find and some of the growth rates in other sectors, we think that that's more attractive elsewhere. On a broad basis, we still do remain quite optimistic about markets from here. And with the sell-off we're seeing, with the deep recession we're going into, we believe that this could actually be the catalyst for the next bull market.